You're watching Sky News. The Bank of England expected to announce its interest rate decision on whether or not to change the rate of interest in the next few seconds. The current rate, 3.75%. Economists aren't expecting any movement this month. We're joined by our economics and data editor, Ed Conway. And Ed, we're expecting it imminently.
Yep, just looking at the screen, they've held. It's 3.75%, so not a surprise there. But this was, let's not forget, a moment when only kind of a couple of months ago, most economists thought the bank would be cutting interest rates at this point, if not having already cut interest rates down to 3.5%. So, it's worth just taking a step back and remembering how much things have changed. But I think the key thing to note, Gareth, here is obviously they've left interest rates on hold, 3.75%. I'm just getting through the vote split, because what happens here is that it's the Monetary Policy Committee. There's 9 members. Looking at the vote gives you a sense of where things may head in the future. And the vote split was 1 member did vote for a hike for interest rates to go up, and 8 voted to leave rates unchanged, which again is kind of in line with what economists were expecting. But as I say, the shift that we've seen just in recent weeks is kind of extraordinary, which you wouldn't guess from just looking at that chart, looking at the actual number, which is to say that the forces that we're seeing in terms of inflationary forces on petrol, on diesel, on jet fuel, on the other kind of things that are now in short supply from the Strait of Hormuz, mean that all of a sudden the most likely direction is not the next direction is not another cut, but a hike. We're just getting, actually, should I read it out? We've just got the quote from Andrew Bailey, the governor of the Bank of England, who says that the war in the Middle East is causing inflation to rise again this year. We've held bank rate unchanged at 3.75%. We think this is a reasonable place given the situation of the economy and the unpredictability of events in the Middle East. We'll continue to monitor the situation and its impact on the UK economy very closely. Whatever happens, our job is to make sure we get inflation back to the 2% target after the initial impact of the war on energy prices has passed. And that last line is quite interesting, because what that underlines is the Bank of England doesn't always have to keep inflation at 2% if it thinks there's going to be this hump in prices, which everyone is expecting now, 4%, maybe even higher inflation in the next, in the coming months as we see the impact going through. But the bank doesn't necessarily need to immediately react to that if it thinks inflation is coming down. So I don't think there's anything that's enormously surprising about this. The main question that we're going to be kind of trying to get the answer to, and Paul Kelso has been in the lock-in, so he'll very shortly have it to us, is what does this mean for the bank's forecast? What does it mean for its expectation for the UK economy? I'm assuming it cuts its growth forecast. I'm assuming it raises its inflation forecast quite significantly. That is what matters, I think, for households around the country. It's what does this mean? Having just gone through this cost of living crisis for the last few years, but barely feeling like we're out of it, now to see inflation at high levels as the bank is likely to forecast, that is something we're all going to be feeling and already starting to feel. Obviously, if you've filled up your petrol tank recently, you have felt that. So we're seeing, I think, not unexpected reaction from the Bank of England, but nonetheless, it is a significant moment, because right now, not long ago, people thought they would be cutting interest rates. And if you have a mortgage, obviously, this has a direct bearing, particularly if you have a floating rate mortgage. They've left them on hold. Most people think that the next move is likely to be an increase in interest rates. And with 8 of the members voting for a hold, but 1 of them voting for a hike, that's one of those little hints that I think economists always look towards in the Kremlinology of what is the bank likely to do next. The fact that not long ago there were members calling for a cut in interest rates and now they're calling for a hike, well, that is significant. So it is one of those moments that's not unexpected given what we've learned recently. But if you looked just only a few weeks ago and what economists were expecting, they would have mostly said that the bank was going to be cutting interest rates.
Ed Conway joining us live in the studio. Stick with us, because let's also bring in Chief Economist at Pamela Liberum, Simon French. Simon, your thoughts to this announcement?
Good afternoon, Gareth. Look, I would echo Ed's points that this is still a big move from where markets thought the Bank of England would be heading at this point of the year. Expectations of interest rate cuts, which businesses and households were widely expecting, economists were widely expecting, have now left market pricing. And indeed, what is going to be of interest when we go through the details of the monetary policy report is whether they are preparing later in the year, and perhaps even as early as the meeting in 6 to 7 weeks' time, to increase interest rates. The decision today is in line with where the market thought, but it's more if oil prices persist at these current levels, can the Bank of England hold the line with holding interest rates at 3.75%?
What will you be looking for in the language of the press conference from Andrew Bailey at 12:30?
So it's about whether he continues to stand ready to act, which is the language he has used thus far, or whether he's moving a step closer. Is there a burden of evidence, a burden of market data to say, actually, this inflation is too hot to handle without it filtering into expectations in the wider economy? Because just very briefly scanning through the minutes in the last couple of seconds, you see that the conditional oil price, the gas price that they were using to make this forecast, was for a fortnight through to the middle of April. Now, that is a long time in Donald Trump world. That is a long time in the Gulf. Energy prices have moved considerably higher. So it will be interesting from Andrew Bailey as whether he says, armed with that new information, there's even more inflation. Actually, he's closer to moving his, and indeed the other 7 members of the Monetary Policy Committee who voted for a hold, whether they would move to an increase next time out.
Simon, really good to have you with us, joining us live here on Sky News. I think we can bring in Paul Kelso, who was in the lock-in. Not quite yet. He's not quite ready, so we'll bring him in a couple of moments' time. But I do have the Chancellor's statement, breaking reaction from the Chancellor, Rachel Reeves, saying that the war in the Middle East is not our war, but it's one we have to respond to. Every choice I make will be about keeping costs down for families and businesses without repeating mistakes we've seen in the past that resulted in higher inflation and higher interest rates. We enter this conflict in a stronger position because of the choices this government took to build economic stability. We're going further to take back our energy security, backing British industry and protecting households. Going on to say that they will build Britain that is stronger, more resilient and prepared for the future. I mentioned Paul Kelso, who was in the lock-in at the Bank of England. Let's bring in Paul, who is live in the city for us. Paul, tell us more.
Yes, well, you've seen the bank has held rates, as Ed no doubt has been explaining. For now, 8 members to 1, which was interesting. There was one, Hugh Bill, who believed that a tightening of the monetary position was required, given what he believes the path of this war is going to play out. What was perhaps most interesting in the background briefing in the monetary policy report, we get one quarterly from the Bank of England, is what it expects to happen next, and trying to answer almost the unknowable question. The key question to every economic outcome is how long this war is going to last and how severe is the energy price shock going to be. That's what's determining everything here, the path of energy prices. The bank admits, the MPC in here, that it can't do anything with interest rates. They can't do anything to impact the price of energy. They're focused on what happens in the so-called second round effects, how that sustained energy increase impacts on inflation that gets embedded in the economy here. So what does it do particularly to food price inflation? What does it do to wage demands as a consequence of rising prices? For now, none of that has yet fed through. The direct impact people are feeling, as anyone who has filled up a car recently knows, the direct inflationary impact is confined to petrol and diesel, but rising transport costs through the economy, energy costs in food production, they are working their way through. To try and set their expectations and guide their decisions, the bank has set out 3 scenarios, they're thought experiments as they're described, based effectively on how high energy prices go and how long they stay there. And there's one in particular, the most extreme of those scenarios, they rather blandly call it scenario 3, but it is a worst case scenario in which case oil prices rise above $130 a barrel at their peak and then stay above 120 for the rest of this year. Well, under that scenario, there's potential of inflation reaching 6.2%, with interest rates having to follow it up to above 5%, 5.25%. That would imply 6 rate increases, a 0.25% at a time, from where we are today at 3.75%. Now, there are lots of caveats to that worst case scenario. It's a pretty chilling number, isn't it? 6.2%. That's getting on for halfway to the post-Ukraine inflationary peak. Now, one of the positive, if you like, in that scenario is that it has gas prices at above 200 pence a therm. Now, they are not that high. When I checked last night before heading into a lock-in that I've just been in, they're around 117p a therm, and that is one of the differences between now and the Ukraine price shock, is that gas prices haven't been so vertiginous as they were back then. And of course, they are crucial at informing the price of domestic energy, a crucial input into inflation as the public feel it, and which for now they're protected from by the Ofgem price cap. Now, the bank doesn't say in which of these scenarios, A, which is a little low on where we stand today, B, which looks like the Goldilocks kind of path of where the markets believe various inputs are, and that worst case scenario. The bank doesn't say which one it believes is most likely. Committee members do talk individually about how far it's likely to go, but it does give us a sense of how much is at play here and how damaging a prolonged energy price shock could be. The one thing, if you like, the good news is the bank hasn't said that worst case scenario is likely. The bad news is that under any of the scenarios, inflation rises and interest rates rise to try and temper it. Under even the lowest of those scenarios, the mildest, scenario A, inflation gets up to about 3.7% from the current 3.3% where we stand today. So if under all the scenarios, to wrap up, if rates rise under all those scenarios, this is based on the market's assumption, and the bank has effectively endorsed those assumptions today. If under all those scenarios rates are going to rise, the question is for Andrew Bailey, and we'll be able to put it to him shortly, the governor, why haven't rates gone up today? And his view, as he set out in a brief quote that we've been handed out ahead of his press conference, is that given the uncertainty around energy shocks and given the uncertainty of how the UK economy is going to react, given that we have a weaker labour market, that might help hold down inflation, it is right to pause for now. And 7 of his colleagues agreed with him. But as things stand from here, almost irrespective of how bad things get, inflation is rising and rates are going to follow.
Paul Kelso, good to have you with us. You've got to get back into the bank for the press conference, so we'll let you skedaddle back inside. But we've still got Ed Conway with us. And Ed, kind of thinking about language, we often hear about inflation as being either transitory pressures or sticky. And sticky was a word that we heard an awful lot during kind of the Ukraine crisis. What are we expecting here?
Well, lots of, I mean, actually, kind of central bankers at the start of that kind of period, so 2022, the beginning of the cost of living crisis. You might remember, inflation was starting to rise actually before the invasion of Ukraine. And the central bankers at that point were saying, "Oh, don't worry, it's transitory. Things that this is going to pass." And then it turns out it wasn't transitory. It was we experienced very high inflation, the highest we'd had in decades. In this case, it's really tricky. And listening to Paul there, it's striking, isn't it? That first of all, the bank is choosing 3 different scenarios. What does that underline? It underlines the extent to which there is enormous uncertainty about where we're heading in the future. But in each of those scenarios, interest rates, as Paul was saying, interest rates are going up. So that we've gone from a world where that line, and you can see it on the charts, behind here, where that line was coming down and down and down, and now, and it was expected to go down to maybe maybe getting on 3.5%, maybe 3.25%, which has a bearing for all of us. This is our borrowing costs. It's also the savings rates that you experience.
Cash in our pocket at the end of the month.
It's the amount of money that, what the bank is doing. It's the biggest economic lever there in the economy, or one of the biggest economic levers, which just makes it more attractive to spend or less attractive to spend. And when that line goes down, that generally encourages people to spend more. It encourages them to invest more. When the line goes up, things get tougher, although saving gets more attractive. The thing worth noting here, so I'm looking right now at the live market expectations. So the millions of people out there making bets all the time on what they think the bank is actually going to do, as opposed to what we're hearing in this monetary policy report. And they think, just looking at these numbers, that the bank is going to raise rates in August. That's kind of nailed on, and most economists would agree. But they also think that it is likely to continue raising them, and raising them up to getting on towards 4.5% by this time next year. So where are we at the moment? We're 3.75%. If they raise them one time, that's up to 4%. If they raise them up to 4.5% or so, which is what markets are pointing towards,
3 rises.
That's 3 rate rises. And that is priced in at the moment by financial markets. And why is that priced in? It's because they're looking at everything. They're looking at the state of the public finances. They're looking at just how tough the government situation is at the moment. They're looking at the oil price. They're looking at all of the different things that, that we spend time looking at. And they're saying, we think it's going to be more than that. And that's really significant here, because we've had tough periods, in recent years, but in each case, the Bank of England has kind of stepped in to cut interest rates when it looked like we might be heading towards a recession. In this case, if markets are assuming that the bank is going to have to raise rates, even though, as Paul was pointing out, the numbers are pretty grisly for the economy, particularly in those worst case scenarios. I wouldn't say it's the worst case scenario, but it's of all the scenarios it provides. That means it's going to be a tough period. And, one hopes, as how many times have we said it so far, one hopes that things improve in the Middle East and the Strait of Hormuz opens, because that does answer so many of our kind of problems right now, bringing oil prices down, bringing gas prices down. But if it doesn't, then this chart kind of turns in the other direction. And I think probably it's already, likely to go up and up. And that comes back to this kind of broader issue that's not even just about economics, which is, if you're a central bank like the Bank of England, you existentially fret about inflation. Yeah. And you need to show just how serious you are when things get tough and inflation gets high. And so even if it's just about showing your mettle, I know that seems like a kind of non-economic kind of term, but really, the gestures do matter as far as these central bankers are concerned, then you potentially raise rates just to show people that you're serious. And it's striking that the one member, we mentioned that there were 8 members who voted against and 1 member voted for a hike. The one member who did vote for a hike was the chief economist of the Bank of England, Hugh Pill, who has tended to be hawkish, as economists would call it, so someone more minded to cut interest rates. Yeah. But nonetheless, he's someone from the bank establishment who is the one who's looking at these numbers, just maybe even more closely than anyone else. And he's worried, and he thinks they need higher interest rates now.
Really good to have you with us, Ed. Let's just bring Simon French back in, chief economist. And Simon, my other thought here is we talk an awful lot about, at the moment, in the immediate term, about the increasing price at petrol pumps, for example. Anybody that drives a car, especially a diesel car, will have felt it wholeheartedly. But there's also the delay, isn't there? Because you think of, for example, the airlines. They've been hedging. They've already bought their fuel at lower prices than what it's being traded at now. So there are still trickle-down effects to be felt for months to come, surely.
Yes, it's the delayed transmission of energy prices that go up first order at the petrol pump after a matter of a few weeks, and then into energy tangential prices, obviously airfares, other parts of the energy-intensive manufacturing sector. And I think the thing that the Bank of England worries about most is a third wave of impacts, when it starts to impact the services sector and workers start to bid up their wage demands because they want to keep pace with the inflation they're seeing in their weekly shop. I think I would also add to Paul and Ed's excellent commentary by saying the Bank of England is also waiting to see what reaction the government might have in terms of household and business support, because one of the experiences the financial markets needed to absorb back in 2022 with a similar energy price shock is the government came along and said, we'll give household sectors, businesses, big amounts of support, a lot more borrowing to absorb, a big transfer from the government in the form of borrowing to the household sector. Now, that makes, paradoxically, the job of the Bank of England somewhat harder. And so, therefore, some of the pricing that Ed was talking about, seeing 2-3 rate increases, is the city making an assessment, perhaps because of the raw politics, perhaps post the local elections through the summer, will mean that we might have a Labour government that feels it has to step in to support households. And the Bank of England then has to respond by offsetting what is potentially quite an inflationary impact of providing that support by raising interest rates.
Really good to have you with us. Simon, Paul, Ed as well. The trio there for you here on Sky News. There's plenty more on the live page on the Sky News website and the Sky News app. That is the live scene inside the Bank of England. We're going to bring you at 12:30 the Governor of the bank, Andrew Bailey, along with several of his colleagues, holding a news conference to discuss the move. The details of that will be brought to you live here on Sky News, so do stick with us for that. 12, 10 minutes to bring you up to speed on some of the day's other stories. The Prime Minister has told criminal justice agencies they must respond in a swift, agile and visible way to the terror attack which targeted Jewish people in North London yesterday. In response to the double stabbing in Golders Green, the government's pledged an extra £25 million to protect the country's Jewish communities. Speaking to representatives, including the Metropolitan Police Commissioner, Sir Mark Rowley, in the past hour, Sir Keir Starmer insisted necessary action must be taken.
It's often said after an attack like that, a terror attack, an appalling attack, an anti-Semitic attack last night, it's often said that we stand with our Jewish community. But we do stand with our Jewish community, of course we do. But it's our fight as well. It's the fight of everyone in this country, because it's about what sort of a country that we want to live in. So yes, we stand with, we support our Jewish community, of course we do, but we've got to make this a bigger fight. It is a fight for what we believe is the kind of country that we ought to and want to live in. So this is our fight, and it's really important, I think, that we broaden it in that way.
Let's take you live to Downing Street and our political correspondent Alex Rogers. And Alex, just tell us more about the people who are around the table and what the outcomes might be. We've heard already this morning about that extra £25 million. We heard also about the fact the Home Secretary will look to change the law to make it easier to kind of bang groups. What else is on the cards?
So in terms of the people in the meeting, we've had senior representatives from the Crown Prosecution Service, including the Director of Public Prosecutions, Stephen Parkinson. We also saw senior cabinet ministers head into Downing Street, the Attorney General Richard Hermer, the Home Secretary Shabana Mahmood and David Lammy, the Deputy Prime Minister, all signs that the government is taking this attack in Golders Green seriously. In terms of what's been announced, Gareth, that 25 million you mentioned, which will see security beefed up around Jewish communities with patrols and extra security around synagogues and community centres, and also, as you mentioned, the legislation to give the government powers to prescribe those state-backed groups like Iran's Revolutionary Guard Corps. In terms of what else could be on the cards, well, there seems to be a consensus forming around banning pro-Palestine marches that we've seen up and down the country. Tory leader Kemi Badenoch is calling for that. Nigel Farage, I think, is on board with that too, as is the chief rabbi, saying this is how hatred festers against Jewish communities. Now, the Home Secretary did commission a review into giving police the powers to ban those protests. So whether we may see some movement on that if the government is seen to be taking this seriously.
Alex, live in Downing Street for us. Thank you so much. Plenty more on the Politics Hub blog. Plenty more as well with Cathy Newman this evening from 7. Now then, police body cam footage has been released showing the moment the suspect, a 45-year-old British national from Somalia, was confronted by officers.
Get down on the ground! Down on the ground! Down on the ground! Step back! Take the taser! Jacket! Take the taser! Get on the ground! Detention of power! Detention of power! Drop the knife! 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 Get off! Drop the knife! Drop the knife! Detention of power! Get off! Pull the arm out! Pull the arm out! Mate, pull his arm up! Pull his arm up! Mate, you're under arrest on suspicion of attempted murder. Should have presented harming defence. Still mentioned when questioned something which you later on in court.
Well, let's get more details from our correspondent Graham Stothard, who's been at the scene of the attack.
The police cordon has now been removed. Earlier on, I spoke to people who were frustrated. They felt that police presence wasn't really active this morning, but we have started seeing more and more police cars. There is still anger and frustration here that words, like you heard Keir Starmer speaking just a few moments ago, aren't being met by action, and that is still a real feeling felt by those who are talking to us today here. Bear in mind, this was an attack that happened in broad daylight in a very busy place. I know someone who someone gave us CCTV, and it actually shows the moments during the attack where the alleged attacker was crossing from Highfield Avenue onto the Golders Green Road and across the road. That was in the minutes before he was allegedly tasered. Now, we spoke to the man who gave us the CCTV. They commented it's unnerving at just how calm he seems, considering he appears to be in the middle of an alleged attack. He also told me it doesn't feel much like the Jewish community is being protected.
I don't like to say that these things, because these things shouldn't happen. So I don't expect these things to happen. But we're prepared. We're prepared in some way that mentally that they could happen. We don't feel protected by a government or by the local police or anything like that. So we are prepared that anything may happen.
Now, David, who we just spoke to there, he also runs a synagogue where actually one of the victims goes to pray. He described him as the sweetest man. Ultimately, there is a feeling at the moment that was voiced there by David, this bubbling anti-Semitic rhetoric that we've seen over the last couple of years has come to a head in the last few weeks and is now boiling into violence that we are seeing. And it's been reflected in an uplift of attacks. Just a few weeks ago, 3 ambulances set on fire around here. There is a feeling that words are all well and good, but action needs to happen now, not just to tackle the symptoms, not just with £25 million for security, but to tackle the cause of this, and that is what they say is anti-Semitic rhetoric.
Details there from Graham Stothard. Well, in the past hour, Iranian state media has broadcast what it says is a message from the supreme leader, Mojtaba Khamenei, saying that Iran will protect its nuclear and missile capabilities. He also said Tehran will secure the Gulf region and eliminate the enemy's abuses of the waterway. Joined now by our military analyst Sean Bell and our Middle East commentator Tara Kangalu. Tara, first and foremost, what's your reaction to the statement? What's your kind of sense of the significance?
Indeed, and I'm actually reading the message that was published on Telegram, the Telegram channel of the Supreme Leader in Farsi. And he starts by talking about the Persian Gulf being a blessing, not just to Iran, but also regional countries. And I think in this message, of course, aside from Garrett, the important point that you pointed out too, is the fact that Iran is now taking this moment as an opportunity to build a new alliance with Gulf countries, independent of course, the United States, because let's remember that for the past 60 days, one of Iran's biggest arguments toward the Gulf countries was that, look, the U.S. bases on your soil has brought you nothing but instability and lack of security. And so I think this is an opportunity that the regime in Iran is taking when it comes to the GCC, essentially thinking of its own security alliances in the days to come. But I also think, by the way, it's an interesting history fact that today, for the Iranians, marks the Persian Gulf Day, honoring their reclaiming of the Strait of Hormuz, dating back to 1622, with the support of the Brits from the Portuguese. So this message comes in that day.
History runs long, doesn't it? Sean, it does indeed. What do you make of the comments about, missile capabilities, but also the nuclear capabilities, because this was all about nuclear capabilities from the outset?
Yeah, I mean, in the same way, we always have to be a little bit careful when President Trump takes to social media, how much we take at face value. Tara is very keen to point out that some of this stuff that comes from, allegedly, from Mojtaba Khamenei may well be for a domestic audience, rather than necessarily for the international audience. But I think what we're seeing is that, again, we've long said talks will be the only way that this gets resolved. And President Trump's claim that actually Iran's been defeated, that they have no cards, each time these statements come out, it's a clearer definition that Iran does have some influence, does have some cards. And by turning around to the Americans and saying, you said you wanted to destroy our nuclear capability, we're going to preserve it. You said you're going to destroy our ballistic missile capability, we're going to preserve it. And we're going to control the Strait of Hormuz with our allies. All of this seems to be positioning, isolating the American view, which, of course, the global challenge at the moment is the global energy prices. And it's just firmly pushing that on President Trump's lap.
Indeed. And again, 2 months in, Garrett, let's remind our viewers that Donald Trump promised that this would be quick, with very little cost. And 60 days in, it absolutely has not been quick. The war is ongoing. And of course, the cost has been tremendous, of course, to millions of people in Iran, those in the region, in Israel. The economy is quite poor there as well. And also, of course, the global markets. To that point, by the way, today, the Brent oil, the crude, 30% highest level since the start of the war. And the gas prices in the United States, over 44% price hike, over $4 per gallon. So this is having a much harsher impact than what the president promised.
And it's also interesting to see how President Trump, what are his options available on the table at the moment? There's widespread reports that he's looking at military options at the moment. Is that really credible? The military action to date hasn't delivered the strategic success he's looked for, so it's very difficult to see how that will work, apart from prolonging the whole conflict. He's also preparing the ground for a longer blockade. But again, the more this happens, the more it feels like the Iranians are saying, look, we're prepared to talk, we're prepared to open the strait, it's your problem.
Really good to have you both with us. Sean and Tara, thank you so much. Let's take you live now to the vaults of the Bank of England, where the Governor, Andrew Bailey, will be giving a press conference following the Monetary Policy Committee deciding to hold interest rates at 3.75%, a decision widely expected by economists, a decision backed 8-1 by the 9 members of the committee. Let's take a listen to them.
Welcome to the April Monetary Policy Report press conference. With us today are Claire Lombardelli, Deputy Governor for Monetary Policy, Dave Ramsden, Deputy Governor for Markets and Banking, and the Governor, Andrew Bailey. Andrew will begin with opening remarks, and then we'll turn to questions. Andrew.
Oh, thank you, Katie. Well, today we've held bank rate at 3.75%. The conflict in the Middle East has significantly affected the outlook for UK inflation. The disruption the conflict has caused to energy supplies has led to a sharp rise in global energy prices. CPI inflation increased to 3.3% in March and is likely to be higher later this year. Monetary policy cannot prevent higher global energy prices from affecting the UK economy and inflation. Our job is to set monetary policy to make sure that the effects of the shock do not become embedded into broad-based inflationary pressures so that inflation falls back to the 2% target and stays there. So I'll now set out how we expect higher energy prices to affect consumer price inflation before turning to the appropriate monetary policy response and the scenarios that have informed the Monetary Policy Committee's decision today. As I will explain, where we go from here will depend on the size and duration of the shock to energy prices, itself driven by how the conflict in the Middle East evolves, and how those higher energy prices affect consumer prices in the United Kingdom more broadly. Chart 1, which has just come up, shows 12-month inflation in the Consumer Price Index since the start of 2024, that's the blue line, alongside our updated expectations for the rest of the year, there in the shaded area. Before hostilities broke out in Iran in February, inflation was on track to fall to around the 2% target from April, that's the red line. Recent data releases covering the period immediately before the conflict began suggest this expectation was reasonable. We now project that inflation will rise to a little over 3.5% by the end of the year. This change in the inflation outlook is a direct consequence of the conflict in the Middle East. Chart 2 shows the scale of the increases in global oil and gas prices. Volatility has been high, and the future path of oil and gas prices will depend on how the situation in the Middle East evolves. Uncertainty around any projection of UK inflation is correspondingly high. Higher global oil and gas prices have a direct effect on UK consumer price inflation. Chart 3 shows how these direct effects have changed the outlook for inflation since February. The prices of fuels moved quickly as global oil prices rose, and higher prices for petrol and diesel have already pushed inflation up relative to our expectations before the conflict. That's the green bars. Household utility bills, that's the orange bars, will follow, and will mostly be affected when Ofgem's next energy price cap for the third quarter takes effect. At this horizon, higher energy costs will also feed through indirectly to consumer prices as firms pass higher costs through their supply chains, that's the purple bars. At first, the The indirect effects on inflation are likely to be largest for food prices, since food production and distribution are energy intensive. Further ahead, lower supply and higher prices of fertilisers may also push up on food price inflation through higher costs and lower yields for UK farmers and across the world. There is nothing monetary policy can do to prevent these cost increases from affecting UK businesses and households. The longer the conflict in the Middle East continues, the worse the impact will become. A resolution at the source, reopening the Strait of Hormuz and repairing the damage that has been done to the world's energy infrastructure, can, however, reduce the impact of this negative supply shock to our economy. The task for monetary policy is to ensure that, as the adjustment to the supply shock happens, inflation returns sustainably to the 2% target. The 2% target applies at all times. But the Monetary Policy Committee's remit recognises that attempting to bring inflation back to the target too quickly after a shock like this may cause undesirable volatility in output. Monetary policy must manage a trade-off between the speed with which it brings inflation back to target and the consideration that should be placed on the variability of output. Monetary policy generally looks through the direct effect of energy prices on inflation. It takes time for changes in interest rates to affect the economy and inflation, so the direct effects from an energy price shock may disappear from headline inflation before monetary policy can take effect. In that case, higher interest rates would only push inflation below target once the energy price shock had passed, resulting in undesirable volatility in both inflation and activity. Even if the lags in the effects of interest rate changes were shorter, offsetting the direct effect of an energy price shock would require pushing down core inflation by generating additional slack in the economy. Looking through the direct effects of an energy price shock avoids such output volatility, as the MPC's remit allows for. The remit also indicates that the MPC should manage a trade-off when considering how much to lean against the indirect effects from an energy price shock on inflation. But because they take longer to come through, the argument for looking through the indirect effects is weaker. Monetary policy can look through some of the inflationary impact from indirect effects to avoid undesirable volatility in output. But protracted indirect effects could keep inflation above target for too long unless monetary policy responds. So by leaning against indirect effects, monetary policy may also reduce the risk that higher inflation becomes embedded through higher inflation expectations and second-round effects. Second-round effects could arise, for example, if a rise in inflation expectations leads workers to bargain more strongly for wage increases and firms raise wages to maintain real pay for their employees, which in turn would increase their costs and could lead them to set higher prices. Monetary policy should not look through such effects, but the size of any second-round effects, in addition to the direct and indirect effects, is highly uncertain. On the one hand, the larger and more persistent the energy shock is, and the more inflation expectations respond to current inflation, the more likely it is that second-round effects arise. And inflation expectations have risen sharply in response to the current energy price shock. Repeated high inflation episodes over the past 5 years may have raised people's attentiveness to price increases. On the other hand, the strength of second-round effects will depend on conditions in the labour market and the pricing power of firms given the state of the economy. The UK labour market has loosened, and that trend has continued in recent months. This suggests that workers will be more cautious in wage bargaining. At the same time, firms may find it difficult to pass on cost increases to their customers, given subdued demand. Higher fuel and utility bills will themselves weigh on consumer demand for other goods and services through lower real incomes and weaker consumer sentiment. The uncertainty of the situation is likely to weigh further on firms' investment intentions. In addition to being highly uncertain, second-round effects build more slowly than direct and indirect effects. That leaves monetary policy with a difficult judgment call. Because interest rate changes take time to take their effect, monetary policy cannot wait for conclusive evidence of the strength of second-round effects. But responding too early may generate undesirable volatility in output, and inflation may drop below the 2% target in the medium term if second-round effects turn out to be smaller than anticipated. To inform its policy deliberations, the MPC has considered 3 scenarios for possible outcomes for the UK economy and inflation over the next 3 years. These scenarios illustrate that the path for inflation, conditional on a market-implied path for bank rates in a 15-day window up to the 22nd of April, depends crucially on both the size of the energy shock and the extent of second-round effects. Chart 4 illustrates the assumed paths for oil and gas prices in each of the scenarios. In scenario A, oil and gas prices are assumed to follow markets futures curves based on the 15-day working day average to the 22nd of April over the next 3 years. That's the yellow lines. In scenario B, oil and gas prices follow market futures for 6 months and an average of the futures curve and a constant price thereafter. That's the purple line. This assumption reflects a more cautious view of the duration of the conflict and the time it will take to restore energy supplies through the Strait of Hormuz than implied by current market prices. Scenario C goes further to reflect the risk of a continued substantial disruption to supplies through the Strait, pushing oil prices to $130 a barrel and gas prices to 210 pence per firm, and remaining higher than in scenario A and B for the entire projection period. In scenario A, there are no second-round effects, in part because the energy shock is relatively short-lived, and in part because it is assumed that workers' bargaining power and firms' pricing power are too weak for such effects to occur, given slack in the labour market and subdued demand. Moreover, demand falls disproportionately more than would normally be assumed to reflect weak consumer sentiment after another supply shock.
We're listening to a live press conference from the Bank of England, the Governor Andrew Bailey explaining the decision-making behind holding interest rates at 3.75%. Breaking news to bring you from the Metropolitan Police. This is a statement that's been shared with us here at Sky News, saying that they can confirm that the suspect behind the situation in Golders Green yesterday was no...
Scenario C is more severe. The energy price shock is large and very persistent. And I would emphasise here the persistence in this scenario. And global supply chain cost pressures intensify. Inflation expectations respond strongly to continued elevated inflation, and firms are assumed to have sufficient pricing power for higher wages and costs to feed through more fully to consumer prices, resulting in materially stronger second-round effects. Chart 5 shows the paths of inflation and the output gap. That's a measure of slack in the economy, conditional on a market-implied path for bank rates based on a 15-day average of forward interest rates to the 22nd of April, along with the central projection from February. In scenario A, that's the yellow lines, inflation falls back quickly once direct and indirect effects have fed through. As the energy shock unwinds and energy prices fall again, while economic slack persists, inflation falls below the target at the end of next year. In scenario B, energy prices fall back more slowly and CPI inflation remains elevated for longer. Inflation then returns gradually to 2% by the second and third year of the projection, but with spare capacity in the economy. In scenario C, persistently high energy prices and second-round effects combine to push inflation above 6%, with inflation ending the forecast horizon above the 2% target. A materially tighter policy stance than embodied in the market-implied path for bank rate would therefore likely to be necessary in scenario C to counter second-round effects to ensure that inflation returns sustainably to the 2% target in the medium term. But that is not the case in the other scenarios. As chart 6 shows, 5 different illustrative policy rules all point to higher interest rates now than they did in February, given the change in energy prices across all scenarios. But the market-implied path for bank rate has also moved higher by about 55 basis points, measured by the 15-day average of forward interest rates to the 22nd of April compared to the corresponding path to the 26th of January from the February report. Since in February, market pricing was expecting rates to fall by around 40 basis points this year, the chart shows that for scenarios A and B, the illustrative interest rate responses would largely be accommodated by reversing out these assumed cuts without further increasing rates. But this would not be the case in scenario C. Since the end of the 22nd of April, oil prices have risen by more than 20%. Gas prices have risen by 8%, and the market implied path for bank rate has moved higher by up to 35 basis points. But if we think back to early on the 8th of April, we saw similarly sized falls in energy prices and the path for bank rate in the day after the announcement of a US-Iran ceasefire. This volatility illustrates the unpredictability of the current situation as the markets are trying to assess the implications of the events and commentaries as they unfold. And I would just add for noting that the range on the Brent oil price this morning is over $10 a barrel. So that further illustrates the volatility that we're in. Given the sheer unpredictability and drawing on the evidence from scenario B, there's a good case for holding rates now. But we must recognise that a prolonged spike in energy prices, as in scenario C, could lead to a higher bank rate, while also recognising that a prompt end to the conflict and a reopening of the strait can take us to the more benign scenario, as in scenario A. So let me summarise. The MPC's decision to hold bank rate today is based on two key judgments. First, that continued weakness in activity and the labour market is likely to lessen the strength of second-round effects from higher global energy prices. But these effects are likely to be stronger the larger and more persistent is the rise in global energy prices. Second, that uncertainty about the strength of second-round effects means that monetary policy needs to balance the costs of leaning too little against these effects against the costs of responding too much. The right balance is likely to change depending on how events unfold. The situation remains highly uncertain. We will continue to monitor the situation in the Middle East and how it affects the UK economy and inflation very closely. This includes the size and duration of the energy price shock and its direct effects on UK inflation. It includes the state of the UK economy and how higher costs of energy and other inputs to production pass through to consumer prices. And it includes the potential for second-round effects of our wage and price setting, drawing on the full range of sources from economic data over surveys of firms and households and intelligence from our agents. I'm sorry that's taken a bit longer than usual, but as you can see, there are more scenarios and more to explain. So with that, Claire, Dave and I will be happy to take your questions. Thank you.
Go to Faisal and then Marine, please.
Thanks, Governor. Faisal Islam, BBC News. Can you just clarify, in scenario A or B, so essentially that the oil price falls from here on in, I get the uncertainty underlying in the geopolitics, but that it may not necessarily require a rate rise? Is that what you just said?
Yeah, so look, obviously, the thing about using policy rules is that there are a whole range of policy rules and you can get a whole range of answers. But as the chart I showed a few minutes ago illustrates, and bearing in mind this point that there was 55 basis points of cuts assumed before, as this set of events started, the conclusion from that analysis is that there is a good deal of room to accommodate the type of tightening that would be needed in A or B within that range of 55 basis points. And of course, the curve has moved to reflect that. So I can't give you a cast iron assurance that therefore there will be no increase in any scenario, or any of those scenarios, sorry. But what I can say to you is that there is a good deal of space was available to accommodate that.
Marine and then Paul.
Mehreen Khan from The Times. Just on the flip side, it looks like, this week, scenario C, which is your most extreme scenario, severe scenario, looks much closer to where we might be at. There has been a huge swing in oil prices, but we hit the 126 mark today. If in June we are in a world where 126 doesn't look so extreme, do you then have to go into what you say is forceful action? And does that include putting a 50 basis point rate hike on the table?
Well, can I make 3 points on that, Marine? And then Claire may want to come in. the 3 points of these. First of all, scenario C, as I mentioned earlier, is a very persistent scenario. So the oil price remains above $100 a barrel through to the end of next year. So that's a key part of scenario C. It's not just where the price is today. That's the first point. Second point is that gas prices don't respond as much as oil prices. The third point is just to reiterate what I said slightly ad-libbing a few moments ago. I mean, this morning, if we'd had this discussion at 9 o'clock this morning, we were looking at a Brent price well over $120 a barrel. Well, I don't know what it is now, but when I walked into the room, it was over, over $10 a barrel lower than that. So that illustrates, A, the volatility of prices, B, as the MPC, we just cannot, stop the music at a particular point in time and say that's it for all time, because it is so volatile.
Yeah, I mean, the only thing I'd add is just to make explicit that point that we've set out 3 illustrative scenarios. They're not exhaustive. They're there to explain, basically, and show how the economy may evolve and how policy might need to react to those. But it's quite likely that the world won't be like, in any of those precisely. And so this is to give a sense of, as I say, how it will flow through the economy potentially and our reaction function.
Paul and then Sue.
Paul Kelso, Sky News. Governor, a question about scenario C, what we might call the worst case scenario you've set out today. Consumers will see potential inflation at 6.2%, interest rates at above 5% again, and they have very recent memories of what that feels like. We've had extraordinarily high inflation from which many households haven't recovered. And I suppose the question many will have is what they're looking for is a sense from you of how likely is that to come to pass?
Well, going back to the point I made in response to Maureen's question, the sheer volatility of what we're looking at makes it, I think, very hard to put probabilities on things. This is the problem, one of the problems we're dealing with. So, we've been very careful not to put probabilities on these scenarios because it moves around too much. I think the point I would make, though, and I think reiterate something I said earlier, this is very important. The longer this general state goes on, the more difficult it becomes. I'm afraid that is something we can sort of fairly easily deduce. So look through the volatility. The longer this problem goes on and the longer the disruption to energy supplies goes on, other things equal, it's likely that therefore energy prices will stay higher and the more difficult the scenario we're in.
But the one thing I would add is the numbers that in that scenario show what happens under the market path. So assume the market path. If we were in a scenario where we saw much higher inflationary pressures like that, we would of course have to take policy action to lean against them, and so that would bring inflation down.
Sue in the middle and then Joel up the top there. She's down here. Yeah.
Thank you. Sue Chan from The Telegraph. Just following on from what Mehreen asked, if we are in a situation where oil prices remain persistently high, what does forceful look like? Are we back in, a 2022 situation where we saw 50, 75 basis point rate hikes? And given your comments just now, when will you have enough info to help you decide that rate hikes might be needed?
Well, I'm not going to put numbers on what forceful looks like, other than to say I think the point was made very deliberately to say that if we see that type of very difficult scenario emerging, then it's important that we obviously do respond quickly to it. But I don't think it's wise to put numbers on it. Your question is a very good question. When will we see it? And it goes back to something I said in my opening remarks. I mean, the challenge for us, and this is the second round effect point, because judging the second rounds is crucial here. Now, of course, the problem is that the second round effects emerge much more slowly. And that's in the nature of it, really, because they're the sort of the follow-on, if you like. And it would be a mistake to wait to see the second round effects before acting, because then it would be too late. So it's, by way of saying, it's a judgment that we will have to make at every meeting. And this is why I stressed right at the end of my remarks that we will be looking at a very broad range of evidence. Some of which will be quantitative, but some of which will be qualitative, based particularly on what our agents are telling us as to how it is affecting the economy. And I would say from my visits around the country, and I'll be out and about tomorrow. We do start in a position where firms very typically say to me they have been experiencing difficulty in passing costs on into prices. But obviously, as this shock is a new feature. Then, I mean, that was the sort of the ex ante state, if you like. Obviously, they're now faced with an abrupt energy price shock, and so we will have to then judge carefully how they both can and do respond to it.
And just on that, if I can just add, in terms of one way of thinking of the scenarios, there are two dimensions to them. One, as Andrew's been emphasising, is the persistence of energy prices. And the second dimension is the strength of second round effects. The persistence of energy prices will obviously, that will be more and more apparent as time goes past. The extent of second round effects will be much more of a judgment as the evidence emerges over time.
Joel up at the back there, and then Sam.
Joel Hills from ITV News. Given that a key judgment is on higher prices and how they feed through and create second-round effects, what exactly will you be watching over the weeks ahead to form that judgment? And with people feeling worse off, isn't it natural that they'll ask for higher pay?
Well, let me take it in two parts. On the first part, I mean, what I did was set out very deliberately a sort of, in a sense, a sequence of things that you look for. So you start, obviously, with the first round effects, which are energy prices themselves. Then we talked about indirect effects, which is how it passes through into the cost of production of other things. And I did put quite an emphasis on food, because I think one of the things we learned 4 years ago was, what a considerable share of the cost of final food is energy. Processed food is energy, so that's important. And I also emphasise food because energy and food are the two most salient things in the basket, the consumption basket thing for people, because they're the things we buy most often and most regularly, and we can compare prices more easily from time to time, therefore. And then you get the second round effects. So those, in terms of what will we be watching, those will be the things we'll be watching. On wage setting, I mean, wages are set in labour markets. Let me make an important point here. Labour markets at the moment are functioning efficiently. There's no reason in any of the very considerable analysis that our staff do on the labour markets to think that otherwise, anything other than that pay is being set efficiently. Now, it will, I should say, be some time before we really do get a read on pay, and the reason is the seasonal cycle of pay setting, because most pay settlements, a large part of the pay settlements are done in spring. So we've actually passed through that period for this year. You're probably immediately going to compare that back to things I said 4 years ago, and I would just make the following point. Coming out of COVID, the labour market was much less efficient. It was not functioning as well. A lot of work our staff did on job matching was showing there had been a real increase in the inefficiency of the labour market in that sense. But we're not in that place today. Wages will be set in markets.
Sam right there, and Josiah.
Thanks very much. Governor, you put in your statement some weight on scenario B, I think. That in terms of the inflation forecast based on the market curve going into the meeting, that puts inflation on target at 2% along the inflation horizon. But that implied that market curve at least a couple of rate increases. That was the curve at the time which generated that forecast. So is it reasonable, therefore, to expect some tightening from here under scenario B? And the minutes themselves put a lot of weight on tighter market conditions, taking some insurance out in terms of adverse inflation outcomes. But at what point do you need to actually validate the tightening in the financial markets by raising interest rates? Thanks.
Well, Claire to come in as well on the final point. Let me start on scenario B. One of the reasons that I think there's one element of scenario B that is more plausible than scenario A, and that's the energy price profile, and particularly probably the gas price profile, because the market curve, which is scenario A, I think does assume that let's be very optimistic for a moment and say the conflict is over tomorrow. It assumes quite a rapid return to pre-existing supply conditions. Now, That's not really consistent with what we hear, and I'm sure you hear from people who, have looked at the damage, for instance, that was done to the gas production infrastructure in Qatar, for instance. Where I think the view that we hear is, look, it is going to take a while to repair that. There's some pretty key parts were damaged. So scenario B, in part, is motivated by building that into the assumption. Now, on the point you raised about interest rates, look, the right decision today is to hold. But it's an active hold in that sense. It's not a passive wait and see hold. It's a deliberately active hold because, as I said earlier, in response to the earlier question, there is a range of scenarios in our view where the headroom we'd got, because let's say it's quite clear that the prospect of cuts, which we were after all talking about at this conference, the press conference 3 months ago, is not on the table now. That headroom could take it up, but we can't give you any assurance on that front. Claire, did you want to?
Not only to add, I mean, as we've mentioned, we haven't put probabilities on these scenarios. You couldn't, I mean, for obvious reasons. So different members will think differently about how they want to weigh the risks of a higher inflation, more persistent scenario, and whether or not, they want to adjust policy in response to it.
Josia, who's right in the middle there, yeah, and then Suban.
Shapopovich, Central Banking. So my question is just with regard to Alan Taylor's comment that given neutral at 3%.
Could you just the acoustics are terrible in this room for when you're sitting here anyway. Could you just talk up a bit? That would be really helpful. Thank you.
I'll start again. Can you hear me now?
Oh, that's great, yeah.
Great. So, Shapopovich, Central Banking. I just wanted to ask about Alan Taylor's comment that given neutral at 3%, it makes sense to hold. I just wanted to ask where that figure comes from. Is that a current staff assessment or a hypothetical? And what are the governors?
I can do it.
Oh, can you?
Yeah, I could hear enough.
Got better hearing than I have.
Maybe. I think that's Alan's estimate of neutral.
Yes.
I mean, it's in his paragraph, so it's his estimate of neutral. In the past, we've published a range of estimates. Claire and I have talked about them extensively at these press conferences, but on different models, different approaches, you can get anything from 2 to 4%. He's been very clear and consistent that he sees neutral as being around 3, so that's very much his estimate.
I think we've said before, some members of the MPC are more confident in their estimates of the neutral rate, and some of the rest of us, I include myself in this round, are less confident about precise estimates, and that's fine. Reasonable people can disagree on that.
And Suban is right behind you.
Thank you. Governor, what evidence would you need to see to vote for a rate hike? And are you close to voting for one? You said you put some weight on scenario C, even if not as much on scenario B. What would you need to see that pushes you to scenario C, and is that evidence likely to come before the next MPC meeting?
What would push us to scenario C?
Yeah, and is that
give greater weight to scenario C, I think. Well, look, I think a lot of it does hang on what happens in the Gulf, because scenario C is in the first instance motivated by more persistent first-round effects. It also has a stronger second-round effects in it, but as I was saying earlier, I think to Sue's question, they take longer to appear on the scene, as it were. So in the first instance, there's a difficult judgment in there about how long is this going to go on for, and that's important because persistence is an important element of scenario C. And what I would emphasise, though, the reason this persistence point is important is that if you look back to 4 years ago, energy prices went up, and particularly gas prices 4 years ago actually went up, but they came down quite quickly, actually. Scenario C doesn't look like that. It's actually it's a different shape to the profile. It's got a much longer downslope on it.
Heather, and then John Paul.
Heather Stewart from The Guardian. Governor, you were at the Prime Minister's Cobra meeting, I think, earlier this week about managing the impact of the crisis. I just wonder what the role of the bank is in that. Are you advising about the inflationary impact of potential policies, for example, or should we infer that there's a concerns about financial stability impact of what's going on? What's your role there? Well,
my role, and I have to be quite careful about my role, given it's an interest rate setting week, is to really, as I think there was a very short record or note of the meeting issued, it was merely to sort of, in a sense, outline the macroeconomic framework, and it really was framework. So, by the way, the meeting was confidential, so I'm not going to talk in any detail, but you won't probably be surprised to know that I sort of laid out first-round effects, indirect effects and second-round effects in terms of the sort of how it works in principle.
John Paul?
Hello, John Paul Ford Rockhouse from the Daily Mail. Can you hear me all right?
Yeah.
Couple of scenarios. Scenario A, which you've just sort of implied is rather unlikely given the energy profile, seems to be the only one under which it's likely that interest rates may not need to rise. Therefore, does it look almost certain, should people take it who are watching and listening to this, that get ready for rate hikes is the message? And sorry, and one further thing in relation to that. Scenario C, at 5.25%, the report suggests that would raise the risk of a recession. Is a recession a price that
so
will have to pay?
The answer to your first question is no. Scenario A, you're right. I, for my own part, think that the market curve on energy prices, particularly on gas, is too optimistic in terms of the time it would take to restore supply. But scenario A has other features to it, and particularly the question about the second round effects. And the second round effects are to do obviously with the length and duration and impact of the energy price shock. So the shorter this whole thing, the less we would expect the second round effects to be. So scenario A is not there for sort of decoration. It's very much a sort of part of the scene in that sense. And as I said earlier, then also parts of scenario, a good part of scenario B would be accommodated by a lot of scenario B would be accommodated by the headroom that we already had. So I would very much give the message: no, it is not the case that we're sort of giving some sort of slightly clandestine message that interest rates are going to go up, notwithstanding what we've decided today. As I said earlier, today is an active hold in that sense.
And the only other factor I'd add on scenario A and the likelihood of second round effects, and obviously different members of the committee will have different views on this, but this, we have really drawn attention, and Andrew has consistently in recent weeks, to the continued looseness of the labour market. Yeah. And that is a very different position for the labour market than we were in 2022.
Oh, recession. So what I would say is, when you look at the analysis that we presented using market curves, scenario C does not deliver a recession. Now, as I said earlier, there's a whole range of policy rules you can attach to these things, and you can get a whole array of results. And there are some policy rules which will deliver you some short periods of negative growth. But however, that's not most of them, actually. Most of them don't do that. So the basic message is this actually delivers a profile of slower growth.
Tom and Dirpa.
Tom Rees from Bloomberg News. As you've suggested, what we've seen the first 2 months of this conflict is actually just a lot of volatility in prices. Crude going from $80 a barrel to 126. Yeah. If that extreme volatility lasts much longer, do any of these scenarios capture something where prices just, fluctuate quite a lot? And I was just also wondering, how much has your thinking changed in the last week? Has the outlook got a lot worse over the last week from what we've seen in energy markets?
Well, two things there. Thanks, Tom. First of all, of course, volatility is hard for all sorts of reasons. It's hard, when you're taking decisions. But you've also got to think about how volatility feeds through into people's expectations. This is a more problematic element to it in a sense, because obviously people are quite saying, well, I don't know what is the. I mean, the first starting point is, what is the price today? Because I said earlier, if you checked into the Brent oil price at some point, this morning, you would get very different numbers depending on what time you checked in at. So that's a further complication as to how people form their expectations. On your point about the last week or so, I mean, you look at the oil price curve. You had obviously it went up. Then you had the period when it was coming back down again, and now it's gone back up again. All of that hangs off, frankly, what's going on in the Gulf. and what's being said about even more so actually sometimes, what's being said about what's going on in the Gulf. So, I think certainly for myself, I think we have to be quite careful here in terms of, I don't sort of pin my reading of the world on one particular period of time, because frankly we've seen such changes since this whole conflict began.
Deirdre, and then Maurizio.
Hello, can you hear me?
Yes.
Yeah, okay, sorry, you never usually can. I just wanted to raise a point in the minutes. It talks about the indirect effects of high energy prices on production costs, likely to affect food prices particularly.
Yes.
How much do you think that is going to affect food prices? And it says inflation is expected to rise somewhat further in Q4. So does that mean that Christmas dinner is going to be more expensive?
Well, because unfortunately a lot can happen between now and Christmas. Just to go back to, as I said, go back 4 years. Obviously, you can't generalise because obviously different foods get made in different ways. But it wasn't when we looked at it 4 years ago. There are quite a few processed foods where 30% of the cost is energy. So obviously that's significant. But then let's consider that, as I say, the pass-through. The question, of course, in the current conditions, current conditions for demand, current conditions in the labour market, and what firms are telling us about their ability to pass costs on into prices, which has definitely become more difficult. There's no question about that. We get that all around the country. I think it remains an open question, therefore, what the impact on final food prices is going to be. That remains to be seen. And I would just re-emphasise also the point I did allude to in the opening remarks about the other effect on food, which is the impact of the problem in fertiliser supply, which again will of course come through over time. Although I know farmers are already telling us, of course, that they're having to make decisions on what they think fertiliser availability is going to be as to what they plant.
We put a bit more detail than in the minutes in the monetary policy report on food prices. So if you look in page 14, you'll see that we say that our short-term forecast out to September 26 takes them up to 4.6%. But then the reports that our agents are getting suggest that they might go up further to a range of 6 to 7% by the end of the year. But that's based on reports as of now, late April. And as Andrew says, a lot can happen.
Maurizio here, and then Ritika up the back there.
Hi, Maurizio Alencar from CCM. Governor, after the last meeting, you said that markets were getting ahead of themselves.
Yes.
And then now you're sort of saying this is an active hold. And I think the minutes report also say that tightened financial markets have become an insurance to sort of inflation. Do you risk sort of actually confusing, the traders out there in the city about what the bank's next move is? And I suppose what's your sort of response?
Let me. Totally fair question. Let me get a little bit of sort of how we got through the last meeting to here. I think that's helpful. We obviously saw quite a move in markets at the time of our last announcement, and I think it comes back to earlier questions. Actually, we were very conscious. I was very conscious that we were expected to cut rates this year. And indeed, look, it wasn't. I go back to the last press conference. I said it. I've said it a number of times. I thought that was my central expectation. And effectively, in the last meeting, in the last minutes of the last meeting, we took that off the table. And I think that we had to do that because, frankly, as you'll see from the material we've presented this time, it's just not realistic. Sadly, but it's not realistic. Now, we know that markets, and this is totally understandable, were pretty substantially positioned based on what we had been saying. That's understandable, totally understandable. And the consequence of taking those cuts off the table was quite a sharp move in the curve. I was not surprised by that because, I say, that in a sense was sadly a fact that followed on the outbreak of the conflict. We did get to a point, I remember, when the 4 or 5 increases were being priced in for this year, I think. And I did make this point. I think you're getting ahead of yourselves at this point. I would stick to that point. And what you see what you see in the much larger amount of material we've presented today is a very broad analysis. As I've said, we've all said a number of times in response to questions. The scenarios show you that there are paths through this where we don't get any more increase. We don't have to increase rates, and the scenarios, I'm afraid, where we do have to increase rates, and that's where we are today. So, look, as I think we've said, and I've said in things I've said today, it's an active hold today. Do I think, therefore, that the interest rate curve is in the wrong place? No, I don't, because there are risks around this.
Ritika up at the back, and then Francine.
Ritika Gupta at CNBC. So there's questions about if you wait for the hard data, whether that means you're going to be behind the curve. So if you did go ahead with an interest rate hike, but then you wanted to reverse that, say there was a quicker resolution to the war than you anticipated, how would you then communicate that to the public? Would you see that as a high cost to reverse that decision?
Well, it's a very good question. First of all, we are in such an uncertain world that, you're right to say, but you don't want to be the people who increase interest rates, and then the next week this whole thing gets settled and everything goes back to normal, and you end up sort of thinking, why did we do that? Well, unfortunately, that's the world we're in. It's a very volatile world, so we have to recognise that could happen. I don't think any of us can predict that, but it's a world we could be in. And I think the important thing is that we have to take this decision at every meeting. We have to weigh up everything. I think I make this distinction, and I'll make it again, between what I call an active hold and a wait and see. Wait and see would be sort of speaking to your point, really, of saying, well, things could happen. Let's hang on. As opposed to taking the active decision and saying, well, this is our assessment of where we are at the moment. There's a range of possible outcomes. We've tried to capture that in scenarios. What's our best judgment of what we do today? And then we have to stick to it. And, we have to face the consequences of it. I think all I could say is I think they'd be reasonably easy to explain if that happened. If peace broke out a week later, I think it wouldn't be too difficult to explain.
Francine, and then the gentleman next to Francine. Sorry, I don't know your name.
Hello, Francine from Bloomberg. Governor, looking at the scenarios, do you think by the summer we'll have a better idea of what we're looking at in terms of direction of travel? Because it is quite volatile. Are you expecting things to settle down in one direction or the other?
Unfortunately, I don't think... Well, look, obviously, to state the blindingly obvious, we will know more. So that's obviously not particularly useful thing to say, but it's just worth saying to start with. Will we be in a position where we can say with certainty that we'll know which scenario we know? I'm afraid we won't, because particularly going back to the point we've made about scenario C, which is it's a lot of what drives scenario C is persistence. It's got stronger second round effects, and we won't know with certainty the answer to that.
Yeah, we'll obviously know more about what's happened to energy prices. We'll just have more time, so we'll have seen the conflict and how that's progressed, and so we'll have a better sense of the persistence of that. On the second round effects, as the Governor says, we'll know more about them from tracking certain things. We will be looking at inflation expectations, we will be looking at wages, we will be looking at pricing power, we will be looking at actually how households respond. Are they smoothing incomes? Are they not? We will be looking at what all of these groups are saying about their intentions. So we'll have some more information, but will there be a moment where you can clearly say second round effects, inflation persistence is taking hold? There won't be a sort of moment like that, but of course we'll have a lot more information, and we'll be doing a lot of analysis, including, as the Governor says, talking a lot to our agents who are out and about around the country, now, and we'll continue to be talking to firms about what their intentions are.
Harrison Moore, Market News. You've noted that tighter financial conditions are already working in your favour, already somewhat constraining a potential rise in inflation. Are you able to quantify in monetary policy terms how much effective tightening there already is, and what data are you looking at in that space?
Okay, Dave, do you want to?
Well, in terms of how we've sort of framed things for the outlook and the three scenarios, and therefore the policy decision, we've as Andrew has emphasised as we set out. We've conditioned the big tightening has come from the consequences of what's happened to energy markets onto rates markets. So the curve that the three scenarios are conditioned on is significantly different than the one we had in February, when I think when the curve then pointed to about 40 or so. I think if you look at the difference between the February curve and then where we are now, you've got minus 40 plus 55 or so over the 3 years. So you've had a very significant tightening in rates markets. But then the exchange rate has been relatively, that's short-term rates markets. We've obviously also seen longer-term rates, gilt rates increase. So the whole curve has moved up. Exchange rates have been relatively stable. There's been less movement in much less movement in risky assets. But I think the key thing in terms of the kind of quantification you're talking about is, we set out very clearly, here would be the consequence of these different rate paths, the same market rate assumption, and then with different energy price assumptions, and then what are the consequences for inflation. So I'm not going to give you a precise quantification, but you can very clearly see the direction in terms of, what would happen to inflation under A, under B, under C, and then draw conclusions about what that might mean for policy, which is actually how we've gone about setting policy.
Ryan and then Jack.
Thank you. Ryan Saby from The Sun. There is a planned fuel duty hike from September. Now, with higher fuel prices adding to inflation, would this 5p increase be particularly ill-advised under any of these scenarios?
Well, I think those are decisions for the Chancellor, not for us. We take fiscal policy, as we say many times, as read, as it were. We base it on announced policies. That policy has been announced. And I think that's a matter, because obviously the Chancellor has to look at the overall stance of fiscal policy, and so that's a matter for the Chancellor.
Jack and then Anna.
Thanks, Jack Barnett from The Times. There's quite an extensive discussion about inflation expectations in the forecast, obviously creeping higher off the back of spot inflation going up. The same thing happened in 2022, and you guys raised interest rates aggressively but weren't able to actually get inflation back down to the 2% target. Are you concerned that consumers just don't think the Bank of England is actually capable of dealing with these types of shocks and getting inflation back to 2%?
Well, a couple of things on that, Jack. Obviously, and I said this in my opening remarks, we do have to take into account that history is something that individuals will factor in when they think about what their inflation expectations are going to be. So that's a reality. But let me sort of draw out, really, I say 3 points that I think where we differ from 2022, and I think these are all important. So first of all, monetary policy is in a more restrictive position today than it was at that time, because the reason it was where it was at that time was the legacy of COVID. But monetary policy today is more restrictive. So we start in a different place. Second, the labour market, going back to what I was saying earlier a bit, the labour market is different today. The problem, it has, as we've all been saying, it has been gradually loosening. And that was true before any of this started, this conflict started. The problem we had in 2022, and this is not a criticism of the policy, was that it was very hard to read the labour market coming out of COVID, in part because the furlough scheme was very successful. It was a good scheme, but it had the effect of really obscuring the labour market in terms of what was going to happen. So we, and frankly all other forecasters, and you can see this from the tables we regularly publish in the Monetary Policy Report, thought that unemployment would rise coming out of COVID, and it didn't. So the labour market turned out to be tighter, and it was hard to read. Whereas it isn't hard to read in that sense. It isn't as hard anything like. And then the third point I'd make is the balance of demand and supply. Again, the problem coming out of COVID was that COVID pushed down demand and supply dramatically in the economy. So reading the output gap was hard. People often say, well, demand was recovering very fast. Well, yeah, but it wasn't back to the levels it was pre-COVID. But then the question was, well, what was the supply capacity of the economy? And that was the other thing that was hard to read. Again, it's not. We're in a more regular situation today. So we look at all those things and in judging this point about how do we have to respond, and inflation expectations will feed into that. But those things are all relevant to where inflation will go to.
And as Andrew emphasised up top of his opening remarks, and as we emphasise again in the monetary policy statement, we'll act as necessary to ensure that inflation does get back to the 2% target sustainably in the medium term. So that's the key message.
Anna, and then Tim.
Hi, thanks. Anna Wise from Press Association. The bank rate seems to have little bearing on the rates that mortgage lenders are charging. They've gone well above 5% this month in response to the war. Is that fair?
Well, the reason is that the mortgage market has changed over the last 20 years dramatically. So if you go back to before the financial crisis, the large majority of mortgages were variable rate mortgages. So literally, if we changed bank rate today, the mortgage lenders would change their mortgage rates tomorrow. Today, it's the other way around. Vast majority of mortgages are fixed rate mortgages. Now, this is not US style 30-year fixes. This is 2, 5, 7-year fixes. What that means is that mortgage rates are priced off the interest rate curve because they have to be, because the banks have to manage their interest rate risk. They're hedging the interest rate risk over those periods. So they're hedging at sort of 2, 5, 7-year point, depending on what mortgages they're writing. So to your point, therefore, mortgage rates move as the curve moves at those points on the curve. Now, us changing bank rate obviously influences that, by the way, and indeed, as today, us not changing bank rate influences the curve. So it's not that we have no effect. The transmission mechanism works, but it's changed, as you say.
Tim?
Thank you. Tim Wallace at the Daily Telegraph. Governor, what's your message to businesses when they're considering their prices? Do they need to resist the temptation to put up prices or the pressure to put up prices in the face of this shock? And also to pick up on what you said about the labour market before, lots of private sector companies have set their wages for this year. They've had the increases already. The public sector is not quite the same. There's still a lot of negotiation going on, strike threats, things like that. Do the public sector wages feed into your forecast?
Well, for businesses, it's really the same point, Tim, as I made about wages. I mean, they're all, prices are set in markets, so businesses will have to obviously look at the markets they're operating, and they have to look at the costs that they are obviously seeing and receiving and taking, and they will set their prices in markets. And so our judgment of second round effects is really a judgment on how those markets operate. On public sector wages, look, this is an issue for the government. I don't think they need. I think they're very aware of the situation, obviously in the Gulf. They're very aware of the impact on energy pricing, on inflation. But those decisions are taken by the government, not by us.
Delphine.
Thanks. I was interested to see you'd flagged the risk of a much sharper rise in unemployment in some sectors than others, hospitality in particular. Wondered if you could talk a little bit more about how plausible you think that is and what it would mean for your assessment of whether the labour market's working efficiently.
Yeah, sure. So we've done quite a lot of analysis that looks at different sectors of the labour market. I mean, one of the big questions sort of prior to this was what is going on in the labour market and how should we think about the different ways to understand what might be going on structurally and cyclically, and so could we get a handle on it by looking at that sectorally. We do see quite a big dispersion between sectors, and actually at the moment the difference across sectors is higher than it typically is, and as you say, we've seen particular impacts on particular weakness in hospitality and in some professional services as well. We've done a lot of analysis of whether or not that is a sort of leading indicator of a bigger problem, and it's not clear that it is in that sense, but obviously there's risks on either side that, and it's something that we're monitoring really carefully.
Have we got everyone? Is that you, Sue? Yeah, go, Sue.
final one then. Looking at chart 1.10 on page 21, can you just describe
21.
how you see the outlook for living standards going forward this year? It's falling.
Well, I think you can see what it shows, which is we have had periods where we've had positive real income growth, and we've had periods where it's gone below the line. I mean, again, what it shows is that it's coming down, has been coming down for a little while, but from a fairly positive position. Honestly, I think what happens hereafter depends upon a lot of the debate or the discussion we've been having in the last hour, which is the balance of what the picture is on inflation and what the picture is on increase in wages and incomes, and say that really gets us to back to this question about second round effects.
It's a negative supply shock.
Yeah,
that's what we're dealing with, and that that is negative to the economy. It is negative to real incomes through the economy.
It's negative to the UK terms of trade.
You can see in the scenarios, you can see just how the difference in terms of the impact on real incomes will be, from the fact that obviously the larger the shock is, the greater the impact. But it is, it's
Will it be painful?
Well, it comes back to this point about size and persistence.
Thanks very much, everyone.
Thank you.